The biggest risk that we face is buying a business from a founder, and if that transition does not go smooth, that really impacts the investment. A lot of great leaders come in, but they're set up to fail because they're not like the founder. They're not like that culture, and they don't get the support of their management team. If you don't have the support of your management team, you either have to build a new team around you really quick, or you're just set up for failure. It's hard to sell a business that could potentially be impacted by tariffs or any of the other uncertainties in the environment right now. So there's definitely less transactions going to market, and of those going to market, less are closing.
If you buy companies, invest in them, or run them, this episode is a masterclass. Today we are sitting down with Sequoya Borgman, ex-CPA turned dealmaker, who launched Borgman Capital in 2017 and has quietly built a retail power private equity machine. Think 500 plus individual LPs, oversubscribed platforms, and a sourcing strategy that wins by avoiding the crowds. Think of second-tier cities, real relationships, and mostly proprietary deals. Why you should care? Because Sequoia's playbook breaks the rules most of us were taught. Raise from people, not institutions, and get more than money back. You get the talent, you get board members, and deal flow. They review 20 deals a week, but only greenlight 3 to 4 platforms a year. Here's how to say no fast and yes with conviction. They very often overcapitalize by 500,000 to $1 million on day one, so surprises don't sink you in the future when bad things happen. They hire operators in founder-led businesses where fit is everything and fix it fast when it isn't. And you have to know when to sell. That's what Sequoia said as well. If it's a home run, take the win and roll forward. This is all what we'll cover in today's episode. I hope you enjoy. And now let's listen. Sequoya Borgman. My guest today is Sequoya Borgman. Sequoia is the founder and CEO of Borgman Capital, an investment firm specializing in acquiring majority interest in well-established, closely held, lower middle market companies. Thanks a lot for coming to the Holdco Builders podcast.
Yeah, thanks for having me on the show.
I was doing a bit of research, and your most unique job so far has been door-to-door satellite dish sales. Very fascinating. I would like to know, what did you learn from that? What can you implement today based on all the learnings? And maybe more importantly, you've been involved in hundreds of mergers and acquisitions, restructuring and financing transactions. There are probably thousands, if not tens of thousands of people like yourself who have those credentials to do those things, but only few actually jump and build a firm of what you've done yourself. Can you maybe share, where does this drive come from, and what was the moment you decided that I'd rather buy companies than advise them? Very loaded question, but you can start.
Yeah, that was a lot right there. I don't know about the drive. I mean, come from very humble beginnings, so I had a lot of those types of jobs when I was a kid, and through high school and college. And yeah, being a door-to-door salesman, it really teaches you what you definitely don't want to do when you grow up. And yeah, you definitely get used to rejection, and that's a plus for really any career, especially in this industry right here. So I think that helped me. But what really got me into kind of the investment side of the business, I went to college and got my master's degree in accounting, and worked for very large international CPA firms. I was a CPA for almost 20 years, working on transactions and with a lot of private equity firms. And that's really what gave me the exposure to the industry and how deals were structured, and how well some of the private equity founders and some of my friends that were running these firms were doing, and worked on some really successful lower middle market deals. And that's really what gave me the itch. I was doing half the work without the upside and the fun of really seeing the whole transaction from start to finish. So yeah, after 18 years in public accounting, decided to take the jump, and really thought about it for about 5 years before I took the leap. It's really hard to walk away from a really nice steady career and do something more entrepreneurial. I talked to a lot of people that have done that, and it's not easy, especially when you have a family and a lot of people counting on you. So I wish I'd done it earlier in my career, but glad I did it when I did. It's looking back, it's been a great career move, and from a timing standpoint, it couldn't have been better. I launched the firm in 2017. It's a great economy, lots of deals getting done. Financing was pretty easy, and a lot of money was going into private equity. So it was really a great timing. A lot of very successful people. They always talk about timing, how it helped them, and I looking back, it clearly helped us get off and hit the ground running and really start from some successful deals right off the bat. Where like right now is a much tougher deal environment. I think people launching right now are going to be have a lot more trouble finding deals, getting the deals financed, and also the equity for those deals. So sometimes it's better to be lucky from a timing standpoint than anything. So yeah, that's a long answer to your question.
No, that's fascinating. And I actually posted on Twitter that a person like yourself, I didn't mention a name or a company name, but the things you've accomplished is coming to the podcast. And one question which I actually got, or a comment, was that everyone fancies themselves as a macroeconomist, but you have a great overview of various industries with your portfolio companies. So the question is like where we are at the moment and where are we heading, like based on what you see, because you have this great overview of different markets, different businesses.
We invest in the lower middle markets. Our businesses are all under 200 million in revenue, under 20 million of EBITDA. There's smaller businesses, and you really have to focus more on not so much the macro economy and how that's impacting the overall economy, but really on the micro side, what's impacting that particular business. And the uncertainty right now that's going on this year is really impacting all of them. I think the top line's a little bit softer than we'd like to be. I'd say that's probably the theme across the portfolio right now. But overall, it's not too bad. I mean, we're not in a recession. Maybe they're not hitting their budget, but they're still up year over year. I mean, that's not a bad environment to be working on. The uncertainty is really having more of an impact on decision making, long-term decision making, strategy, capex, buying businesses, selling businesses. It's hard to really make a long-term decision when there's such a uncertainty around what's going to happen over the next 3, 6, 9 month. It's starting to settle down a little bit. Some of these tariffs, companies are working around them and seeing how they're impacting their businesses, and getting a little bit of certainty around interest rates and everything else that's going on right now. I mean, the job market is actually more pro business right now, so that helps some of our businesses. And again, on the lower end of the middle market, there's less international exposure for a lot of these businesses. So some of them are actually benefiting from the political environment that's going on right now.
Now, not too many people have this experience of doing hundreds of deals, restructuring, financing, all that. So maybe one more follow-up question before we move forward on what exactly are you doing today? Like what maybe those early mistakes or different deals you saw taught you the most about your own approach on what type of businesses you would like to acquire, invest in, all those lessons from those previous deals?
Say it a lot, but I think the biggest mistakes are really around hiring. All these businesses, the biggest factor besides buying right, of course, structuring it right, is really the leader that you put in charge of running these businesses, creating value. And sometimes you do your best diligence around a person. And again, not all firms are investing in the same box. Our box, we're buying family-led businesses, founder-led businesses, and transitioning to a new leadership team for the most part. And our early mistakes where we've hired the wrong leader. Somebody looks really well on paper, somebody that interviews really well, their references come out really well, but for whatever reason, either culturally they don't fit with that company, they don't get the support of their management team, or they're just not the right person for that particular business. That's where I'd say we've made some mistakes. I do want to say we've probably corrected those mistakes early. In the majority of those cases, you can tell really early in the investment cycle and the hiring cycle if that leader is going to be a really good fit or not. So we don't let that drag out. But I'd say probably 50% of the time we've had to make changes in that leadership, unfortunately. We've gotten better at it over the years, but that was one of our earlier mistakes. And it's hard to replace a leader. I mean, especially somebody that's founded a business or run a business for 30, 40 years. They know that business inside and out. They are a huge portion of the value of the business. And a lot of times it takes not just one person, but 2, 3, 4 people to replace that one person since they're so integral to the business. And I think that's what some investors, they underestimate the value of that entrepreneur, of that business owner, of that CEO, president that's running that business. And a lot of times hiring 4 people to replace that one, that costs the business quite a bit of money too, and impacts your EBITDA, impacts your return. So that's all part of our analysis when we're going in to buy a business.
And how involved are you today when it comes to doing all the hiring, meeting those right people? Because there are portfolio of, you made like 20 acquisitions so far, like 8 platform companies.
Yeah, we've bought 20 people. We're pretty involved. We've got 15 people on our team. We've got a kind of a value creation platform that we really are involved really on a daily or weekly basis. These are, again, small businesses. They're not large middle market businesses that can run themselves. They all need help. Some of them run more autonomous than others, and that's really a testament to the leadership of those businesses. But others need a lot more, and they're smaller businesses. They need a lot more hand-holding. They need a lot more help. They need us to help them open doors and really help with day-to-day operations. So it really depends on the business and depends on the investment. Some of these are growth equity investments, which those need a lot more help than I'd say a traditional established business with an established business plan.
You've said that, you started, the first acquisition was in 2017, and now it's year 8 for you. You've said being an independent sponsor is more stressful than you expected. What would your read this first note to your 2017 self be if you would do it today?
It's clearly more stressful being an entrepreneur and having a lot of, thousands of employees. Their livelihood is really in your hands, and these businesses and their communities and the charities they're supported. It's a lot of responsibility, and you're responsible to a lot of investors and their personal net worth and the banks. I mean, the banks are probably the most stressful part of the kind of leveraged buyout business, and that's not something that's probably going into it you think about as much as when you're sitting on that side of the table. When you're a consultant or working in the industry, the stresses are different. Their deadlines, their client customer demands, those types of stressors. But really, that's less of an issue. Once you invest in a business, the stress is, your fiduciary responsibility is to get the best return possible for your investors and for us. We invest in every one of the deals personally. That's from time to time. Every business goes through cycles. And it's different things that are impacting them, and those definitely keep you up at night. No different than any entrepreneur that's ever started a business or run a business. A lot more to it than people think.
Hi, a very quick pause from this episode. I want to talk about today's sponsor. If you like what Sequoia is building, but you don't have a pipeline of proprietary deals yourself or just an overall deal flow, check out CapitalBat. It's where investors back the next generation of business buyers. Inside, you'll find vetted searchers, real acquisition opportunities, and deals you won't see on public brokers. Think serious operators, clean data rooms, clear timelines. If you believe in backing builders, not betting on moonshots, head to capitalbat.com. Discover operators out there hunting in those overlooked markets, which we've been talking about with Sequoia as well, and partner on great small business buyers and put your capital to work alongside people who execute. Accredited investors only. Again, that's capitalbat.com, and I'll put the link in the show notes as well. Now, back to the show.
And what is the story of the first acquisition? You don't need to mention the industry, the business, but how was the financing? Because you do it in a bit different way, using retail investors. How were you able to put it all together after leaving your job?
Actually, the first deal fell apart. I like to tell that story because a lot of people think it's easy. It's not. I had a deal under LOI, and the seller changed their mind about a week before close. I had to go home and tell my wife. She thought I was crazy for taking the leap, walking away from a great career, and then the deal fell apart. But fortunately, right after that one fell apart, a commercial banker that I'm good friends with introduced me to one of his clients that had just had a deal fall apart. He had walked away. He wasn't comfortable with the buyer, and I met. He introduced me on a Thursday. I met with the owner on a Saturday, and by the next Monday, we were shaking hands and had a term sheet place. A really nice material handling business that we invested in. Closed about 90 days later, and it was yeah, it was a great investment. We've since sold that one. It was a home run from my standpoint. I'd definitely invest in that space again, but again, it's just networking and relationships really matter in this business. And that one, it was just a good friend that introduced me. And again, we that one, it was traditional bank financing, and we did have a small sliver of mezz in that transaction, and then the rest we filled in with personally I invested in it, and then we got 26 other investors. There's one family office that was the largest investor, and then 25 kind of high net worth individuals, ultra high net worth individuals filled in the rest of that. Yeah, the lesson from that is, I mean, a lot of those 26 individuals, I didn't know them when I launched. I asked, I mean, probably 100 and some people that I knew to invest in that deal, and maybe they passed, but they introduced me to somebody that was was interested in investing in private companies. And I always say you just have to keep asking until you get it filled up. That was the only deal that we weren't oversubscribed. I think we're undersubscribed by about $50,000, and we had to put a little bit extra money in personally to get that deal closed. But ever since then, we've been oversubscribed on every deal. But the lesson learned is just keep asking. I mean, not every deal is for every investor. Some investors like growth equity deals, some investors like venture deal, like real estate. It's just, you need to talk to the investors that really like investing in private businesses. A lot of people have built their net worth around running a private business or being part of a family business, and they like investing in these types of transactions.
I always like to ask, like, how did it feel? Because this was, you had made the jump, you had succeeded because you were able to acquire a business, like having 26 investors backing you, including your own capital. How did it feel the first week, first month, and how long it took for you to move forward doing acquisition number 2, number 3, and or the thesis was in the beginning just to do one, or how was it all?
I don't know if we really stopped to celebrate that first one. Looking back over the 20, I mean, when you get one deal done, then you're kind of on to the next one. That's part of the industry. But yeah, so we closed that one, and then probably about 3 months later, we had another one lined up and closed that about 60 days after. That was actually one of our largest transactions we've done to date. Was our second transaction. Really nice business in the food industry. That one we were introduced through another investor, kind of a mezz investor, introduced us in on that transaction, and that one we still own. That's been a really great investment. We've done some add-ons for that and really grown that business. And during the diligence for that one, we got the third one lined up under LOI, and it's kind of gone like that ever since. I mean, you're always busy, kind of, you can't stop looking for the next deal while you're in the middle of another deal. And that's why early on we really ramped up more than some other independent sponsors. There are a lot of independent sponsors that there's one or two people that get together and they buy a company, and you find that you get overwhelmed with just the day-to-day responsibilities of managing that business. We brought on employees and partners really early in the life cycle of our firm, which allowed us to have the bandwidth to continue to acquire more businesses. And we also put together really strong boards for these businesses, really strong outside board members that know the industry inside and out and can add a lot of value. That's helped us from a operations standpoint, and also allows us to invest across different industry segments. I mean, we're not an industry expert in every industry that we've looked at, but we make sure that we partner with those people who know the industry inside and out.
When you take those 20 acquisitions so far, how has it been? Do you find company and deal first, and then you start looking for a CEO or leader, or it's the other way around?
We do it both. There's a lot of people. Some firms call them operating partners. There's a lot of people that want to buy a company and run it, and we meet with a lot of those. We go after deals with them. It's hard though to find a really good investment at a fair price and have the leader in place day one. It really, the stars have to align for that to happen. It's more likely that you find a good company for sale and then we work our network to find a really good leader to run it. That's a more likely scenario. Just from a timing standpoint, it's hard to, people that are looking to buy a company, they're usually look for a year or two before they go on and take another role, or maybe less. So by the time you find something, maybe they've already moved on to another role. So that's just the challenge of aligning with somebody and looking for a business. Because the business we just bought recently, it took us 20 some months from talking to the family to closing on that transaction, and it's hard for an executive to sit on the sideline for that whole period of time.
Now, today you have 500 plus retail investors and you launched the website Pass the Hat. What is your thought process or thesis going with retail investors instead of raising a fund, for example?
Yeah, we get that question quite a bit. We could have raised a fund a long time ago, but I feel like the investors, those 26 investors that support us from the beginning, and the now 500 plus investors that have supported us on 20 some transactions. I mean, if we raise the fund, they would not be able to participate in that fund for the most part. And they've been loyal to us. They've supported us. We've been oversubscribed on, like I said, every deal except that first one. And why would we want to walk away from that? I mean, there is a lot of value. People underestimate how much value these investors provide to these businesses. I mean, if we need references for executives, or we need a business to open some doors. Among those 500 investors, most of them are very successful individuals, own their own businesses. They can really help us provide value on these businesses, create value, and really impacts our return. So that's when you have a fund with a handful of institutional LPs, you're not getting those referrals, you're not getting and a lot of the investments we've made have been referred through that network as well. And they've really grown. I mean, especially within the family office network, they all talk to each other. If they like kind of how you manage the investments and your investment philosophy and your thesis, they talk to their peers in the industry, and it doesn't, we have 15 people in the team, but we have nobody that's in a investment relations or investment role going to meet with these. It's all been kind of internal referrals for the majority of our investors.
And how do you manage it all? Like 500 people, that's a lot. And have you ever had to fire any investors because not maybe wanting them to invest in the next deal because of different reasons?
No, I mean, fortunately, I actually don't mind that. Especially same with like on the board meetings when you have people that have different ideas and different ways of looking at things, and it actually adds value. So of those 500 investors, I'd say the majority of them, I enjoy when they give me a call and tell me some ideas on how we can improve operations or increase revenue or things we should be thinking about. Those are great conversations from my standpoint. So no, we've never had to fire an LP. We've been very fortunate.
You said you were a bit lucky with the timing, with the great deals coming to you, closing those, doing more and more. If you were starting today, like maybe people listening, they have some great deals, how would you set up the investor list? The same way you just shared before, that you just go and talk to more people? Is it that simple?
I guess I wasn't aware of the whole independent sponsor network and how there is a lot of capital available. So, I mean, you can either do the route that we went, and we've been down the route so far that I don't think there's any going back, or you can partner with one LP that'll put in the majority of your equity and maybe take a little bit more of your upside, but it's a lot simpler. And I mean, the one downside of having as many investors as us is it does take up time during the diligence process, and maybe we only have 60 or 90 days at the most to get the transaction closed. It does take my time and my team's time to raise the money during that period. And if you partner with one or two larger LPs, which there's a lot of them that love to back these direct deals, it does free up more of your time to focus on diligence and focus on getting a transaction over the finish line. So there's positives and negatives of both structures.
What is the smallest ticket someone can invest when it comes to investing in your acquisitions?
That first deal we allowed checks as small as $50,000, and since we did that, we've kind of kept that as our base. Some of the bigger deals, there's probably not room for checks that small, but we try and allow some of our early smaller investors to participate in every transaction that they have an interest in. So we've never really raised that minimum.
Now, let's say you have a deal under LOI, then you might have 60 to 90 days. How do you contact with all those people, and how do you make sure that you actually get the deal done? Because you have to talk to a lot of people, a lot of investors.
Yeah, fortunately, again, we looked through a lot of transactions to find good ones at good valuations, and once you do that, you have a lot of interest. So we usually wait till we've got a good idea around the numbers. We'll do the QV. Once we're very comfortable that finance is in place, that the transaction's not going to change, that the numbers are tying out, that any major diligence items have been addressed, then we'll put together a whole offering memorandum and a book, and we'll send it out to all of our LPs. And then about a week after that, we will have a virtual investor call and kind of walk through the investment thesis. We'll walk through any questions any of the LPs have. We'll open up the data room for any sophisticated LPs that really want to dig in and read through all the diligence documents and read through the legal documents and quality of earnings report and everything that's in the data room. And then we give another probably 7 to 10 days to have follow-up questions, follow-up calls, make a commitment. So we'll know how to allocate the available equity out to the group. And again, it's a non-binding commitment till subscription agreements are signed. So even though we're usually asking for kind of an indication of interest in the deal within probably 10 days or so of going out, they usually have about 30 days before they have to make any type of real binding commitment. And then after the subscription documents are signed, and then they usually another two to 4 weeks before we really need the money wired. So it's about a 2-month process, depending on the deal. Some of them are shorter, just given maybe we only have a 60-day exclusivity, then we'd tighten the timeline for raising the money. But in a traditional 60 to 90-day diligence period, that's kind of the timeline. Is about 10 days to look at things, 30 days to get a commitment, and then another 15 to 30 days to wire the funds.
You launched the site passthehat.com to bring new investor. How has it worked, and what maybe has worked best when it comes to attracting those new investors who didn't know you before?
Yeah, we launched a separate platform really because we were changing our internal kind of fund administrator. We outsourced our fund administrator to a new group, Asset Class. Now handles all our back office fund administration, and InvestReady handles a lot of the credit investor checks and stuff like that. And we want a separate platform for onboarding new investors. So we launched passthehat.com. Our main website, borgmancapital.com, is really focused on business owners that want to sell their businesses to private equity or private investors. And passthehat.com is really focused on individual retail investors or wealth managers and their clients who want access to direct private equity investments. And yeah, it's been great. We just need more deals. Has been the problem. We've got plenty of investors. We just need more good companies that want to sell. There's a lot of larger private equity firms that are going after the retail segment right now. There's less liquidity on the institutional side, and I think we got ahead of that by launching this new platform. And yeah, it's worked out great so far. Again, we just need more deals to be able to put on the platform.
Hey, one more quick pause. I want to talk about another sponsor, but first, let me ask you something. What's the fastest way to make deals, capital, and talent come to you? I believe it's to be known. And the simplest way to do that, week in, week out, is to write a very good newsletter, because most capital allocators, they love to read. But if you don't have the time,
Spacebar Studios will do it for you. They do the strategy, writing, design, and the distribution. They do the whole thing. They're also grow your list. In fact, they've got an offer right now. If they don't grow your list to 10,000 subscribers in the first 90 days, you don't pay. And this is a very good offer. So if you want the same inbound engine Sequoia was talking about, where relationships, leads, capital, and operators show up because you're consistently top of mind, go and book a free call at spacebarstudios.co. Go talk to the team and go and see what you can build. Again, spacebarstudios.co. I'll put a link in the show notes as well. And now back to the episode. Maybe a few words about the overall market in private equity, because we can see yours is working very well based on all the deals you've done, and we discussed some of the success stories as well, like knowing many people in private equity. What is going on in private equity at the moment, and what you think will the next maybe 5 years bring?
Yeah, there's a lot of appetite still for private equity. Unfortunately, there's less liquidity. Transactions, valuations are down a little bit. Just banks are putting less leverage on deals, which means you can't pay the same amount and get the same return. And people are just holding on to their companies given the uncertainty. It's hard to sell a business that could potentially be impacted by tariffs or any of the other uncertainties in the environment right now. So there's definitely less transactions going to market, and of those going to market, less are closing. We had one that we tried to sell earlier this year that did not get over the finish line, just given some of the uncertainty that was going on for that business. So we're seeing a lot more of those. And I think once there's some more certainty, the economy's a little bit steadier, we can see out 12 months or so out in the future that there will be a lot more transactions. And I think private equity will pick back up. The lending environment, even though the banks are a lot more cautious right now, there's a lot of funds that have been raised to go after the debt side of the leverage buyout business. So I think that the funding's out there. It's just less transactions for the moment. And that can only last for so long because there's still a lot of buyers out there. There's a lot of business owners that are aging and want to sell their businesses. They just don't want to sell when valuations are down. If they know they could have sold for a lot more 2 years ago, they'll just hold on for 2 years and sell in 2 years rather than sell right now when maybe the valuations are slightly down from when they were 18 months or 24 months ago.
One very interesting thing you're doing is you're not doing those deals in those big cities. I'm not from US, I'm from Europe, but you like cities like Portland, St. Louis, Kansas City, Omaha. Why focus on that? Why focus on those second-tier cities?
Again, most of our transactions have been referred to us through our network, and I feel like in those smaller cities, relationships still matter. You still can find nice businesses for sale through somebody you know personally, or through a commercial banker or attorney or accountant, where that's less so in the large cities. Most of those, it's more of a transactional. There's a lot more competition in the New Yorks and Chicagos of the world, and that drives most of those businesses go through professional kind of auction processes with investment banks. But in the secondary cities, again, people want to sell to somebody that they know is going to take care of their business, going to take care of their employees, going to take care of that community, and continue to support the charities that they feel strongly about. And those are the types of businesses that we want to buy. Those businesses where the owners really care about those types of things, and those transactions tend to go much better when you have an owner like that.
You've said that 80 to 85% of your platforms are proprietary, like off-market deals. What have been the top sources for that? And do you see this changing in the future, or getting even more those off-market deals coming to you, or how is it at the moment? Because something you mentioned previously was you would like to just have more deals. There's enough capital at the moment.
Yeah, the off-market deals, they're always hard, and there's no true proprietary deals. I know people say that they only focus on proprietary deals. Most business owners talk to multiple buyers before they sell, fortunately, and that helps set kind of expectations. I know when like we're the first person to talk to a business owner. A lot of times their price expectations are much higher than reality, especially in the lower middle market. They hear about some big transaction that sold for some large multiple, but that's not really reality in the lower middle market. So once they talk to 3 or 4 or 5 buyers, they kind of get an idea of what their business is really worth. And that's the perfect time to be talking to these. And most of those are referred in by, again, their trusted advisors, their attorney, their banker, their insurance agent, or their accountant. Those advisors know who is active in their geography in buying those types of businesses, and they make an introduction. They may not just introduce us, they may introduce us and 2 or 3 other parties, but we'd much rather buy those businesses where we can build a relationship directly with the owner. We know that he or she is somebody that we can trust, that cares about their business, and will help us make sure that that transaction to the new leader or leadership team goes smoothly. Because that's the biggest risk that we face, is buying a business from a founder, and if that transition does not go smooth, that really impacts the investment, especially early on in the life cycle. I mean, I'm sure most people have heard about the private equity J curve for that first year where you're making investments, or you maybe lose a customer or a key employee or something like that. That impacts your long-term investment. So if you have a great relationship with that owner, it can really help you through that first year or two transition period. It really helps you long-term and increase your IRR and cash on cash return.
How many new deals do you review with your team per week? And maybe what moves a deal from being interesting to just let's go, or what it takes to being interesting versus just let it go, not focus any time on this?
Again, I'm a numbers guy. We look about 1,500 deals a year. So each week we meet every Monday for an hour and a half. We go through all the pipeline of the deals that came in the week before, and some that maybe are coming in slower, that maybe it came in several weeks earlier, but we hadn't had the financials yet. And we go through those deals. The probably four or five that we really like, we dig in deep and go through that. But I mean, I get probably 10 books a day. I mean, it's just crazy how many you get of the investment banked or brokered deals. And being a former CPA, it takes me less than 2 minutes to flip to the financial statements, and you can really see the health of that business just based on some of the financial trends and how the business does from a cash flow standpoint. And those are the businesses we're buying. So it really has to check that box first. And then once it has some healthy financials, we're not buying turnarounds or restructuring or anything that's really going to be a heavy lift. We're not really just not structured for that type of investment. We're looking for nice cash flowing, bankable businesses with strong teams in place, good business models, and we really just want to maintain. I always tell the owners we'd like to buy great businesses and try not to mess them up, and it's easier said than done, but you can tell within a couple minutes if that's the type of business. If that's the type of business, then we'll dig in and we'll spend whatever time it takes. We'll fly to meet with the owners. I mean, we're on the road or flying around pretty much every week of the year. I know for the last 5 weeks and the next 3 weeks I'm flying somewhere. I'm actually flying out this afternoon I mean, that's where you find good businesses, is fly these smaller municipalities and meet in person.
How do you structure deals? Because one thing you said that all your deals, except the first one, has been oversubscribed.
I mean, again, there's a large appetite for individual investors and family offices and some smaller institutions to get access to these nice lower middle market deals at the multiples that we're paying. So that side of the business is I mean, truthfully, looking back, that's the part I didn't understand when I launched, that there's more appetite for investors than there's actual opportunities to invest. I mean, I wish coming up early in my career, I had very successful, high paying. I was partner of a big international firm, but I never had access to invest in these direct deals. So unless you know somebody that is buying these businesses, or you know somebody through your country club or your network, sometimes your financial advisor or wealth manager will get you some access to some bigger funds. But most people, most very successful people, really have little access to invest in these types of things. So there's really more demand, more appetite for these investments, and there's opportunity to find them. So that's looking back, that's the one part of the business I didn't really understand as much.
Do you think it gets better now when it comes to all those social media platforms? I know my guys from Borgman Capital, they raise from retail investors. Do you think it's more and more of these, or there will always be like plenty of capital and not enough good deals?
Well, the capital goes where the returns are. So as long as private equity returns remain above market, I think the capital will be there. I think returns will, and they have been going down really the last 2 decades. I mean, as more competition, more private equity firms, more leverage buyout shop, it drives up multiples, and that drives down returns. So I think if there's too much capital going after the space, it will impact the returns. And then, you might as well invest in an ETF if you can get liquidity and less risk from the leverage. But as long as the returns are there, there's going to be plenty of capital.
One thing you've said before, that sometimes you add this when the deal becomes oversubscribed, sometimes you add this extra $500,000 or $1 million cash to the balance sheet for the future events. How often do you do that, and what is the thought process behind this?
We do it on most deals. You never know where working capital is going to fall out. We do it just from our structure. Like if we had a fund, we would know the day we're closing really what working capital is, where fees are coming, all the transaction fees, what type of cash the business needs to operate. But with our structure, and we have to have the money lined up and wired probably 30 days before close, we don't have that opportunity to really adjust at the last minute unless you want to go back out to all the investors, and that's just very messy and would hold up the transaction. So we've never really done that. We could personally put in more money if we had to. So that's always an option. But really we do that just so there's a little bit more and more room. And I mean, another $500,000 or $1 million on a $20 or $50 million transaction has really a very minimal impact on the IRR. So that's why we've done it. Really make the certainty of close, because the worst would be come up and the bank says we need another $500,000 to close because working capital is not where we thought it would be. And then that holds up the transaction for 30 days. We've got to go out to investors, and time kills deals. That's why I say all the time. So in that 30 days, who knows what could happen, but it's better to get those things closed. And we're conservative. I mean, we're not putting large leverage on these businesses. We're overcapitalizing them, and that helps you through the cycles as well.
Now, when it comes to operators, teams, and maybe running those companies, 8 platforms. Now, when it comes to replacing a founder CEO, it's always risky. And you've said that you have success rate of 50%. What do the good hires have in common?
I wish they had something in common, then make it easier. No, I feel like you have to find the person that's a great fit for that particular business. And every business the culture is different, and it's really based on how that founder or owner built that business, what culture's embedded within that business. And a lot of great leaders come in, but they're set up to fail because they're not like the founder. They're not like that culture, and they don't get the support of their management team. If you don't have the support of your management team, you either have to build a new team around you really quick, or you're just set up for failure. And I think that's been the biggest challenge, is you need a leader that can build the support of the management team. That's tough. That's really hard.
And on the time-wise, how long do you give to these people, to this new CEO, and what is the first move when you realize it's not a good fit? We
usually give them about a quarter or two. I mean, it's a board decision. We don't make it ourselves. I mean, we're very hands-on. Well, I wouldn't say hands-on with all the businesses, but the ones that we have a poor leader in place, we spend a lot more time with. So we're meeting with them daily or weekly at the minimum, and we breed them board in and just say, should we give them a little bit more time and to figure this out? Because it takes a couple of years for somebody to get up to speed on a new business. We don't expect them to recreate the wheel or do fantastic stuff right off the bat. Same with salespeople. When you come in, I mean, it takes a year or so before you start getting a return on that sales role. Same for presidents. But the ones that you know are not a good fit, it doesn't help to drag out the timeline. I'd say those we give about 3 months, and then we usually bring in an interim or we go through a search and then have a outside recruiter find somebody that's a fit, and then we'll interview them. The board will interview them. Sometimes they'll meet with the leadership team or the former owner, just make sure they are a cultural fit. We'll do all the personality profile assessments, and yeah, I mean, the second person tends to have more support of the management team, just because if they didn't like the first person, they tend to like the next person. So I'd say it's hard to follow a founder, but following somebody that was not a good fit is a lot easier.
Now you have this quite large portfolio. What I'm trying to ask is, how do you manage it all? Let's say there is a portfolio company maybe losing a big customer or supply issue or something with tariffs. What's your standard maybe 30, 60, 90-day plan, or how do you manage it all?
I don't have to do it by myself. Like I said, we've got 15 people on the team. We've got 4 offices around the country now. We've got a lot of resources, and we've got a lot of outside resources too that we bring in when challenges arrive. We don't try and do it all ourselves. There's a lot of great consultants out there and a great operating partners and others that have helped us quite a bit. And the good thing is when you find outside party that helps one portfolio company, you can use them to help across the portfolio with those similar challenges. We've got great HR consultants and you name it. So that's the one thing of having done as many transactions as we have. And then we also meet once a month. All the portfolio companies share best practices, and they also share challenges that they're facing. And within those companies, there's somebody that faced that challenge that knows how to address it. We don't bury our heads in the sand. We get ahead of it. And also, when we make the investments, we do have a 60 and 90-day plan, investment thesis, and we really try to implement those fairly quickly, and that helps too. Just really have a plan. You always have to pivot because a lot of times you go in with one thesis and you figure out that that's not the best path, and you've got to pivot, but you have to have a plan.
What is your plan when it comes to you buy and build, or you buy, improve, and sell? Because so far you've had like 3 realized investments. What is your take on this? And maybe you can share some of the exits you've done.
Yeah, I mean, it depends on the company, depends on the industry, depends on what the competition looks, whether it's a buy and build or it's more of a growth equity play, or it's just a really nice business that's already growing, and you do add risk to that business when you do add-ons. So we have some really nice businesses and some of our exits where we did no add-ons, and we have some others that it's just a very fragmented industry with lots of small competitors that are really ripe for a roll-up, and other businesses there really is no competitors that you can buy, and again, if you do buy something that's not a great fit, there is that risk, that integration risk, and the risk that you don't really add value. You don't just because you can buy another company doesn't necessarily mean that that's accretive to your original investment. It really depends on kind of where you're investing, and then yeah, we've done some growth equity investments that really we have no leverage on, that we just put additional equity in there to grow those businesses, and those businesses you usually don't have to do add-on acquisitions because they're growing nicely themselves just organically.
Now you mentioned you have 4 locations so far, I believe, and I guess you have a plan to grow. So what is your maybe take when it comes to hiring those new local origin like operators who will do exactly like what you have done, because this works? What is your take on that, to find those boots on the ground people?
Yeah, we'd love to bring on more people. I tell people that want to do what we're doing that we already have the platform, we have all the back office, we have the track record, we have the investors, and we have the banking relationship. We have everything we need to be successful. So if somebody's thinking about doing it, you can either go off and do it yourself and build out that platform. And it's not easy. If you're able to do it, great. But if you want to join somebody that's already established, we'd love to kind of talk to them, and really you have to be able to source transactions to be successful, though. You have to source good investment opportunities. If a person has a great network and can do that, we'd love for them to join us.
What does, let's say you find these great people, what does the first maybe 60 to 90 days look like for that person in this new location?
Yeah, it's a lot of networking. I say when I launched the firm, I think I had 200 coffee meetings and lunches and dinners within that first 60 days or so. And I think when people join us, that's really what they're focused on, is getting the buzz in their local market. We throw a launch party where actually we do that in all our locations, and then we do it once a year just to get that get all the COIs and influencers in that geography aware of what we're looking for, what kinds of businesses we're looking to invest in. But that person really has to do a ton of networking and let everybody know in that geography that they're looking to buy businesses and what types of businesses, and then they after that first initial 60 days, and the rest is really meeting with all those referrals and meeting with businesses and reaching out and going to a lot of networking and conferences and that type of things.
Now, trying to understand, what is your edge, or maybe what are you doing differently from other investment firms? Let's say if we watched your investment meetings for a month, what would be different from other people, other funds?
Well, there's a lot of fun, so I'm not sure that we're different from all of them. I mean, there's 1,500 or so independent sponsor groups, another 2,500 or so funds. So there's a lot of competition. The thing we do different, again, we're really focused on the relationship. We want to buy something from a business owner that we respect and we trust and we feel like wants best for that business. And if we hit it off in that meeting and we see eye to eye, I mean, it's like any partnership or relationship that you enter, you're not going to hit it off with every seller, and that's key. But if you do hit it off, I mean, we pay fair prices, and we're not out there trying to be a bottom feeder or we just want to find really nice businesses with owners that care about their business, because those that care, we tend to do much better, and that's really our focus. So if that resonates with a seller, sometimes the seller, all they care about is just getting the highest price and moving on, and those tend to be not the best fit for us. But there are other groups that maybe that's a better fit for them, and that's the thing. If you're a seller and you have a good business, you have plenty of options. Besides, I mean, all the independent sponsors and the funds out there. I mean, there's a lot of family offices that are going after a space. There's a lot of strategic buyers. I mean, everybody that has a good business, they've got a lot of options, and we're just one of those. And I'd say we're kind of a hybrid of a fund. We've got all the resources of any lower middle market fund out there. With 15 people, as much resources we have, we can compete toe to toe with any of those. But since me and my partners, like some of these transactions, I'm the largest investor in the company. I mean, we're similar to some of these family offices too. With our structure, we can be long-term hold. We can be very flexible around the structure and rollovers and really what the owner wants to do. So we're kind of a hybrid of the two when it comes to it, and that does resonate well with some, because some business owners don't want to sell to a fund that they know they're in the 5th year of that fund life cycle, and that business is going to be resold in the next 3 years, and their employees are going to have to go through all that turmoil in the short term, and they'd prefer to sell to somebody that doesn't have that flip mentality.
Do you sometimes back the searchers as well?
Yeah, we love searchers. I wish I've said it many times. I wish I was aware of that when I was coming out of college. I don't think it was a thing. It's much more popular these days. But people that are doing these searches, if they find a great business, we'd love to back them. Some of them, they have some backing for maybe a small business. Maybe they're trying to go buy a lawn maintenance company or something, and those are fine. Happy to help and give them advice and help them with the structuring and just talk through. But maybe they run across a business that's bigger than they expected. Maybe they have a family friend that introduces them to a business that's really bigger than they can bite off. We'd love to partner with them on those types of transactions. And same with, again, there's a lot of independent sponsors that are, it's a one or two person, and they find something that's way bigger than they can do themselves. We've partnered with those types in the past as well. So the searchers, I mean, if they can find something and do it themselves, they're going to do great. But if they need help or want to look at something together or partner up on something, we'd love to see if we're a fit.
A few general questions. What's maybe the most misunderstood risk of raising money from hundreds of regular investors? Because you have 500 of those. Maybe something people don't realize.
There's a lot of regulations, SEC regulations around it. So make sure that you have the best attorneys. Don't cut any corners. Make sure that you're having a third party do all the accredited investor checks. That's the biggest risk. And don't take, there's been plenty of people that want to invest with us, but don't understand kind of what they're investing in, that it's illiquid. They can't get their money back whenever they want, that these businesses are leveraged. The bank gets paid first before they get paid. I mean, people that don't understand the risks, I wouldn't take their money. That's the biggest thing. And that's what opens you up for liability too. And don't oversell it. Be truthful. Say, yeah, these are long-term illiquid investments, that these businesses go through cycles. There can be downturns in the economy that'll impact your investment. Just be very open and honest with the investors. I think the risks are people that they just get desperate, that they want to raise the money and they oversell it, and they maybe say some stuff that may not be 100% accurate, and that's what opens you up for a lot of liability. So those are the big risks when you're I wouldn't say unsophisticated investors, but investors that don't know what they're getting into. I would not take money from those types of investors. They really have to be an educated investor that wants access, that knows they're investing in a business, a small business that's smaller than something kind of on small cap public company, and those businesses have a lot more risk, and that's why there's higher returns as well. And again, the leverage in the you hear a lot about financial engineering and private equity. I mean, the leverage is that financial engineering, but it's also a risk. It's like buying stocks with a margin account. You can get a higher return, but you can also get totally wiped out if those stocks go down. Unlike a margin account, the company is paying the interest on these leverage. If you were putting 100% equity in to buy the business, the returns would be much, much lower. But, I mean, if you buy a business with 50% equity and 50% leverage, and you pay down that leverage over 5 years, I mean, you've doubled your equity investment in 5 years. That's a great return without really doing anything on the business, but that's a risk as well.
You mentioned these are illiquid investments, but I guess investors still have some expectations. What do you say to them? Do they get their money in 5 years, 10 years, 20 years?
We model out 5 years on really all of our investments. You have to pick a timeline just so you can model it out. But I always say the banks gets paid first. We deleverage the business before we pay any distributions. There are some tax advantages to holding a business here in the U.S. for 5 years and not paying distributions. Qualified small business stock. So if it's a deal under 50 million, and now under the new tax regime, it's under 75 million, which is a big portion of our deals. So sometimes we don't pay anything for that first 5 years just to take advantage of that. But that's the expectations. I'd say wouldn't expect to get anything back in that first 5 years. Really deleveraging the business, which takes the risk off in the first 2 or 3 years. And then you want to reinvest in growing that business. That, from an expectation standpoint, that's what we usually say. It's about 5 years before you'd see any type of liquidity. Unless we sell them. And again, we bought a business that did really well. We doubled EBITDA in 3 years, and we got a really nice offer from a public strategic in the space. We didn't go through a process on that one, and we sold it in 3 years. But that wasn't the plan going into it. The plan going into it was for a long-term hold.
What is your take when it comes to holding and selling? When is the right time to exit?
My experience is once you're greatly exceeding your investment thesis or expectations is to sell it. And the biggest tell is when a lot of people are calling me or giving us inbound offers for that business. I know it's a great great space. It's very hot space, and that doesn't last. So usually when that happens, maybe we'll get a couple offers, but then we'll hire an investment bank to go through a process and sell. And that could be in different times, and it could be early in the life cycle of that business. It could be later in the life cycle of that business. But that's usually I don't believe in holding on too long because the businesses do go through cycles.
Now, if we take 5 years from now, what's true then that isn't true today? What do you want to build in 5 years?
We're having a lot of fun. I mean, I'd love to continue what we're doing. I mean, there's very few firms that are our size in 8 years. So in 5 years, if we could continue that growth trajectory, maybe do more transactions, larger transactions, have some more exits. I mean, the good thing with exits, it just gives me more funds to invest in the next deal. So if we can only buy so many before you personally run out of money. So you have to sell from time to time. But yeah, I'd love to just continue what we're doing and bring on some more people and that want to do what we're doing and buy some more nice, great companies.
2 quick fire questions. What is the best investment advice you've ever received, and what is your favorite book?
Best investment advice. I think the best investment advice was actually one of my partners told me early in. I used to be very, very rigid around negotiations and sticking to my guns on evaluation. And he said $500,000 is not going to make a bad deal good or a good deal bad. So that's the one thing is the small little numbers are not going to impact it. So look at the big picture. Is it a great investment? Then get the transaction done. If it's not, then walk away. That's the thing. Don't negotiate and I tell our attorneys too. I mean, attorneys can tend to over negotiate some of the minute details of a purchase agreement, and that can really impact the whether or not the deal closes or not. So look at the big picture. There's a lot of risks in doing what we do. Make sure you address the material ones and some of the smaller ones. Price it into the transaction, and you're more likely to get the transaction done. And then on the book side, I am a huge reader, so I always have about 10 books on my nightstand. I wish I had more time in the day. Right now, I've started at least 6, and I'm about halfway through. So I'm not sure if I have a favorite book right now. I did like the do hard things. I'm big on pushing yourself, like physically and mentally. I climbed Mount Kilimanjaro this past year, and doing those types of things, I really enjoy. So I think private equity, I mean, these investments, they're tough. And I say it all the time, that if it was easy, there'd be a lot more people doing it. And there's enough people doing it as it is. But I think that's a great book if you haven't read that book recently. And if anybody has any suggestions on books I should read, please reach out to me or send me an email. And I'm always looking for new suggestions. I just need more time in my week and in my day to get caught up on the ones I have right now.
Okay, Sequoia, thanks a lot for sharing your story. I hope people start reaching out to you, either independent sponsors who would like to maybe open a new location for you, or just people sending you book recommendations. But again, thanks a lot for sharing your story.
Yeah, thanks for having me on the show. This has been great.